All right, in this episode, it's a episode one of two. Paul and I interview Barry Dyke. Now, Barry is a best-selling author, advisor, money manager, speaker, and this guy's committed to telling the truth about how Wall Street really works. Barry, does incredible, detailed investigation. I don't know how many hours and hundreds or thousands of hours he puts into these books, but he's written several books, and Paul and I are big fans. We had a great time recording this. Paul, what's your favorite book of Barry's?
Ooh, you know, I haven't read the most recent one. We just got a kind of an advanced copy of it, but I think his original book, Pirates of Manhattan, 2007, where he essentially predicts the what happens in 2008, the great financial crisis, and
Yeah.
just a phenomenal, just a cool guy to hang out with. He's a car guy. He likes Porsches, and I'm a car guy, but phenomenal insight into how things really work on Wall Street. And he likes to point out that he is not anti Wall Street or anything like that, but people need to be aware of how it really works and what's really going on.
Right. If you want a better understanding of the problem, Pirates of Manhattan is a must read. So put that on your list. Make sure you get that one. So, all right, everybody, enjoy episode one. We'll be back next week with episode two. Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses: the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, we're back. Hey, Paul, we are joined today by one of our esteemed colleagues and one of our favorite, most interesting people to talk to. No kidding. His name is Barry Dyke. He's an author, written multiple books, and he's got a new one coming out this year at some point. We'll definitely get into that. But Barry, welcome to the show.
Great to see you guys. You guys looking handsomer than ever.
Well, thanks, Barry. That's why we invited you on for the compliments. So yeah, we just spent some time in the Bahamas not too long ago, getting to talk in person. So that was awesome. And the year before that in Vancouver. So I assume we'll see you next year in Puerto Rico next summer.
Who knows? Yeah, it's just yeah. I've been pretty much tied up with this research or whatever. So that I've kind of put any business on hand. This is to me more important than anything, any production I've been doing. So really, for you guys and for the next generation. So
Well, thanks for what you do. And as everybody heard in the introduction, we listed all the books that you've written and highly, highly recommend. Like this is one of the first ones I read and that was recommended. Maybe it's not showing too well, but Pirates of Manhattan, written in 2007, right before the crash,
yeah,
right?
yeah,
And
yeah.
and then what did you predict in that book was going to happen before too long?
Well, I explained why mutual funds don't work and why banks are highly unstable, and something was going to happen with derivatives. So I didn't, I'm not God, whatever, but I just did a lot of research. I said this is really unstable. Guys like Henry Paulson from Goldman Sachs said this is the best economy ever, and I said this guy's crazy. And so then we had the subprime crisis in 2007, and sort of remains of this subprime crisis are still really kind of lingering on to this day. Even some class action lawsuits still haven't been settled to this day. So the financial ramifications of Wall Street and what they're doing to the American public goes on and on and on. And so the way it is right now, guys, in the economy is that if you're really rich, or if maybe you're a long-term government employee, all due respect, or a state or municipal employee, you're going to be kind of okay for retirement. But for the vast majority of people, if they're in a precarious position. So nothing's really changed. So anyway, so what I'm trying to do is help people, build, stronger balance sheets, and be concerned more about what they really care about, their families, and the people who they really love.
And that's great. And you come at it from really well, tell us a little bit about your background because you are, of course, you're an infinite banking concepts practitioner. I mean, you're an IBC guy. You've been in the
Yep.
business for over 40 years, but tell us a little
Yep.
bit about your background as far as, you manage money as well. So, what's your
Yeah,
background
yeah.
there?
So I have an investment advisory firm. I've had that for 24 years, whatever. But I've been kind of blessed. I was all a very entrepreneurial kid. I had my first business when I was 14, mowing lawns, and I was successful, believe it or not. And then, and I was in high tech, believe it or not. Before I was in the insurance and advisory business, but and I used to sell parts to missiles and sidewinder missiles, and
Oh
then
yeah,
kind
the
of
AIM-9
I was
Sidewinder. I used to carry those.
but I was involved in that. But anyway, so I always wanted to work for myself, and I started the insurance business and Prudential. Wow, it was 40 years ago at this point, and the so anyway, I started doing that, and then and I was successful at it. Started with Prudential, was Rookie of the Year, blah blah blah. I went to New England Life, started a pension business, sold out to New England Life in '89, set up a third party administration firm, and she was in 99, where no 80, excuse me, 1990, and then sold that to my partner in '96. And but I along the way I did a lot of benefits. I did 401k plans. I was one of the first guys actually to do a 401k, believe it or not, right in New England. And I did self-funded retirement plans. I work with publicly traded companies and a lot of closely held companies. So I had a pretty good background in the business, if you will, and knowing benefits. So I knew a lot of the stuff really didn't work, and then I just mutual funds. I thought they don't work really, consistently over a period of time, but uh, they're being forced onto the public, and so I became exposed to a guy, and a mentor was Robert Castellone, who founded Leap Systems, who showed me
Right.
really mathematically how this stuff doesn't work and never work. And then the blessing of my life too was I became good friends with Nelson Nash, and I was going through a very tough time. It's all in the first Pirates book, but I was going through a very rough time, and I discovered that that what banks did and for themselves and what they did for the public are two different things. And then Nelson Nash just kind of encouraged me, says, "You have to finish this battle." You remember Nelly? He was just a wonderful, wonderful, wonderful man, and he said, "You have to finish this." And so I did, and so the rest is kind of history. But that was 17, 18 years ago
Mhm.
when 2006, seven, when that book came out. So it's been a long road, and but the blessing is I get to meet a lot of guys like yourself who are trying to tell people the truth, because you're not going to hear it in the mainstream media.
Well, I think it's amazing. So you said you'd been in the industry for quite some time before you really understood what banks were doing.
Yeah,
And so that's not something they teach even guys like you who are in the financial management industry and asset management and all that. Like that's something you still have to discover on your own. So what was so eye-opening to you about when you realized what banks were doing with money versus what maybe they advertise and tell us to do with money?
well, that's the whole thing. We don't have really an education system, guys, in this country. We have an indoctrination system, and as Nelly would say, and so I I read a book, and I was actually at a business conference, at a Leap conference. I think it was this in and the San Diego, the Del Coronado Hotel out there. It's a beautiful, beautiful. Ever been there? I don't know if you guys have ever been there. It's beautiful. One of the first places that Thomas Edison ever put light bulbs. And I was at a conference there, and someone said, "You got to read The Creature from Jekyll Island about how the Better Reserve is not better when there are no reserves." And
Hmm.
you got the creature that right there. Paul's got his copy. So anyway, so I said, "Oh my God." And I kind of intuited, see, because I came from the Northeast, and it's a very affluent area and very old world connected and the whole thing. So I knew a lot of this stuff, was rigged, by whether it be the Ivy League institutions or the private prep schools around here, all interconnected. So I knew this stuff. but I said, how does this get done? And it's through the banking system. And then when I figured out that the Federal Reserve was not federal and there were no reserves, and it has much common with the federal government as Federal Express does, my eyes got open.
Yeah.
And so that's, so that was kind of the aha moment, whatever. And it was also, it was a time, guys, at the time I was going through a tough, very tough divorce. And so what I did, I kind of recycled my pain, and I just started reading everything I could on banking. So I not just read the Griffiths book, and I've actually spoken at conferences with him. But I read Griffiths book and a whole bunch of other stuff, and I got everything in my hands I could on it. And so I just became very anal about it and started researching it. And I said, "Oh my God, this is just a big freaking scam." And and I'm for capital markets, and I'm for venture capital and all that stuff, and I'm not against. But what I found is it was a rigged system, really, for the people, the top 1%, and it's more. I'm convinced more than that than ever.
Yeah. So here's a question, and I get this from Paul. You probably get this from clients, and maybe Barry, you do as well, where people, they're watching the news and they're hearing about the value of the dollar going down,
Yeah.
and everybody uses this word, the dollar crash. Whether that's a possibility or something that would happen or gets exchanged as the world currency, the world reserve currency, who knows? But what are your thoughts on that? And specifically the thought of, really how much of your wealth to keep in cash, because we accumulate capital inside of our dividend paying whole life insurance policies.
Yeah. Yeah.
Right. So what are your thoughts on that, and how much should be kept in cash, and what should we do with that? Not saying this is, an investment advice podcast. It's not, but
No, it's
definitely curious.
So the whole thing, this will be coming out in the Pirates 3 book, by the way, guys, which the problem is American. It's really kind of an American problem. And this is why I'm very passionate about it. Um, America is just I love this country. Don't get me wrong. I love this country more than you would know. But the problem in America, there is no savings, actually, and the top savings rate, I think, is like Norway. I think they're like 20%. And I have this. Wasn't prepared to get into these statistics, but anyhow, so Americans don't save. During the financial crisis, I think it was actually negative. So we're actually borrowing money to stay afloat, and it was no really different than the pandemic. So, getting to your question about how much people should save, generally a rule of thumb, guys, is 15-20% of your money should be going to savings, into life insurance, your insurance or investments and things of that nature. 401ks, I'm not against that stuff. So you generally should be saving 20% of your gross income into savings. Now, it's difficult because the cost of living is so massive, because inflation's gone way up, because they've been printing all this stuff to bail out everybody except for the regular folks. But the whole thing, when you have private capital, and you guys have been doing this for some time, you can take advantage of opportunities. If you don't have anything, then you're relying upon credit or credit cards and things like that, and which gets into another kind of a whole usury type of debt, like a philosophical perspective, which is it's very difficult to address, because credit cards are so evil. And they're kept up, and they're the highest, one of the highest profit margins for all the major banks like J.P. Morgan Chase. So the whole thing is, and then what I see what you guys are doing is not just helping people accumulate capital, but also just have them stay out of debt. Does that make sense?
Yeah. I think debt is certainly a killer, right?
And so
debt.
So roughly, if someone makes $100,000, the ideal would be roughly $20,000, in savings, and if everyone did that, there would be no reason for planners like you or I. Okay, but the people really don't, and people are saving money in if there's a 401k, or Paul, as I mentioned, a TSP plan, okay, which is the largest 401k in the world. it's money in a straitjacket for the next till they're age 59, and so the institutions have all the fun with the money, and you're kind of locked out of it unless you retire or get disabled or die or something like that. So the whole thing is really to the thing with it was Nelson really told me the importance of warehousing capital, but it was Bob Castellone who showed me that the mathematics behind a 401k are very erroneous. And when you kick in inflation and taxes, it just but unfortunately, and this is the reason why in this book, which I'm coming here, the retirement rules to pitch it. Do you know where US of A stands in the terms of retirement plan preparedness in the industrialized countries? The top 25, Paul. Paul, do you know? Did I tell you?
I know because I listened to your podcast with James.
Right. I think it's 22nd.
I think it's 19.
We're 22nd.
Oh, 20. Okay. Well, Paul's got a better.
We were 19.
Okay.
Okay. So we probably have the best military system in the world. Okay, but our retirement plans are third world.
Right.
I mean, this is I saw this and the real problem is that and then Peak they came out with this study, Alliance for Lifetime Income came out with a study this past April showing that there's like roughly 30.2 million baby boomers retiring between 2025 and 2030.
Yeah.
And 2/3 of them, the only asset they have is Social Security for income.
2/3. Wow.
2/3.
So is that what you mean by, so what does that actually mean that we rank 22nd in the world for retirement planning? What does that mean? What is that based on?
Well, it's not me,
Right.
so it's Mercer, and you can find it online. Mercer out of Australia. Each year they do a comparison study of who has the best and who has the worst in terms of financial stability, integrity, and all these things.
Okay.
All these different factors. I can hang on, I can just tell you it's in the book, but the so and this has been kind of consistent, and let me just tell you.
So we've actually moved down in rankings because about a year ago we were 19, and then just recently,
exactly.
The most recent update was 22.
That's what kind of shocked me. We were like 18, 19, and 20, 23, and now we're at 20. We're 18, 19, 20, and 22, and now we've slid down. So in terms of overall, adequacy, sustainability, integrity. And we had the worst integrity. The only one who was worse was France, but I don't know. But they get to take off August, so I don't know what to say. But so the whole thing is that we're up the paddle, guys. I don't know, and we're up the creek, and on this stuff. So people really have to know what's going on with their savings plan, and the whole thing is, and you guys know it, that the 401k or the TSP, whatever you want to call it, and to be honest with you guys, it's kind of the same in a lot of the other countries, but in America, there's nothing to protect people against themselves, and so I see it almost something out of biblical prophecy, and they say in the end days, good is bad is good, and good is bad. So when I'm saying things like life insurance and annuities and things like that, and loving, caring up family, discipline, and all these really good things,
traditional family values,
which are really good things at the heart of the country. Is being promoted as bad,
right?
Okay, and and this crazy LBG. I don't want to get going on that stuff, but because I want to stick to finances, but. So all this stuff, these highly speculative stuff, are being promoted as something good. It's crazy.
Yeah, and these average Americans, Barry, or just typical Americans, I don't want to say average, just the everyday American is they don't really have a plan for. There's a retirement show that I listen to on the weekends around here on WMAL, and It's all about a distribution plan. What's your distribution plan? These people have no plan for an income. And they've accumulated all this money in a 401k, of course. That's where all of their wealth resides, or in their house. It's one of those two places. But they have no plan on, am I going to run out of money at some point? So I know that, part of the problem is, and that's what we focus on with our clients, is educating our clients and then telling them, hey, or asking them, what is your plan for income? And we work with a lot of government employees. Sure, they have a pension or whatever, but most people don't, right? There's very few private pensions in existence nowadays, right? Does that make sense?
It's non-existent. I have I have the statistics. I think there's only like 64 open DB plans. This is a friend of mine, Steve Church, is an actuary, and there's only 64 like public pension plans, public companies open, and I think only like 27 have the traditional. 27 of them have traditional benefit formulas. So, yeah, it's the private pension for the most part are dead. Now, now the irony of the whole thing, which I get into, IBM actually is changing that because the 401k doesn't work. I will get into this in the Pirates 3 book, is that IBM is actually kind of going back to the future, and they're stopping their contributions to the 401k, and they're setting up a cash balance retirement plan.
Cash balance plan.
Yeah,
Wow.
because my parents-in-law have they both retired from IBM and they have pensions with IBM. So you say they're actually going back towards that because they transitioned to 401ks and now they're going, yeah. So the baby boomers or those just right after baby boomers perhaps also benefited from that defined benefit plan. And then,
Yeah.
the 401ks became the rage and
Yeah,
they're
yeah,
seeing the error in
yeah.
their
So,
ways.
so you said you had in-laws, or
Right.
yeah.
Yeah.
So the whole thing is, the reason I bring that up is, IBM, they're like in 175 countries, and they have 288,000 employees. It's and they've always been kind of a Cadillac, if you will, and they always treated their employees as the compensation as really kind of the model of compensation, and the whole thing. They've always been a front runner. And my point is that they say, hey, this thing doesn't work. Now, this whole thing about IBM using reserve credits off their old DB plan to fund the cash balance, and I don't care. The thing is, it's a sane way to do it. It's a better way to do it. Now, the thing is, people still can use a 401k as a salary deferral, but the whole thing is that the core is going back to the whole defined benefit plan. And if you study all the plans around the world, and I have, they're all annuity based. And they're all annuity based. So this is why, if they get this book, okay, the Netherlands, for a number of years has always been one of the top ones in the world, and because it's annuity based, and so not just the life insurance, but as you know, with the life insurance, you can do a 1035 exchange into, if you have a large whole life policy, you can turn into annuity. Because that's what all pensions originally were. They were life policies, and they converted it to annuities.
Huh.
So yeah, that's what actually with the Presbyterian ministers in the 1800s, 1600s, or whatever, they first started. There was whole life policies, and then there'd be cash accumulation, and then when they endowed, then it would be turned into a life income stream. So that's what all pensions are. They're all annuities, but I'm not against the markets. But the problem is, guys, it's this simple. Everyone calls these 401ks retirement income plans. Would you agree?
Sure.
Okay. What's the purpose of retirement income plan? To produce income.
Right.
What's in America? It's gamble. Let's gamble with it. Let's do this inverse ETF, or let's put crypto in it, or So that's
what there's so many people when they think of retirement, they think of a number. Like, I need to accumulate this number. And when I say something like, really, there's only one thing you need to retire. Income. That's it. You only need one thing to retire is income. What's your income number? And then you got to work backwards from that. So, but like, advisors don't teach people that. They just say, how much do you want when you retire? How am I supposed to know how much I need when I retire?
As much as possible.
As much as possible.
That's what I tell people. So yeah, so that's I was in that movie. I don't know if you guys saw the Baby Boomer Dilemma.
I've
Yeah.
not seen that. You've mentioned it before, and I need to.
Yeah,
Where
I
can
go
we?
to
Where can our
you go to
listeners find that?
Let's put a link in the show
yeah,
notes for that.
Yeah.
boomermovie.com. So it's a long story. I was kind of edited out of it. I just get a cameo appearance in it because I got a bunch of my friends in the movie. Okay, but I was kind of edited out because some of the research which I presented to Bloomberg News about a decade ago,
Mm,
they wanted to have the filmmaker wanted to put in the movie, but the people behind the movie said, "Nah, we got to cut Barry out. We don't want to get sued by Bloomberg." So, but yeah, but anyway, so Ted Benna, who's a friend, he's a guy who created the 401k. He's in it, and then another friend, Ted Siddell. He's one of the top whistleblowers, one of the top pension experts in the country, is in it. There's some really good people.
Is Tom Hegna in that one?
Tom Hegna's in that one. Yep,
Yeah.
Tom's in it, and but David, I'm having
Oh,
a
the
senior.
comptroller.
Dave Walker is a friend of mine, and he did the forward to my book. He's in it, and a lot of other people from Wharton, and a lot of academics are in it. Essentially
Yeah.
saying that you really should have an annuity as a cornerstone,
Right.
and so yeah, so that's done well. But people can go to boomermovie.com, and then but that's one if you guys haven't seen it, and it's really part of the solution because the whole thing is the 401ks. I tell people a new toaster from Walmart has more guarantees than a 401k.
right. Right.
Yeah. Yeah. Imagine that. And that's why we love whole life insurance so much is for guarantees. So I know Paul and I are just, experts in one thing, and that's life insurance.
Yeah.
Um, you've got a lot more vast experience in other things, annuities, market investments, etc. But let's transition a little bit to life insurance here and banks. So you
Yeah.
talk in Pirates of Manhattan 1, about how much bank-owned life insurance there is out there and how much permanent life insurance is on the asset column of the bank's balance sheet.
Yeah.
Why is that? Why do banks own so much life insurance?
Yeah. It's stupid.
Yeah, it's
These
terrible.
guys, I mean, I question their morals, whatever, but they're not stupid. I mean, first of all, as first of all, folks, and although they're like casino on wheels, okay, their own account, they don't gamble. So, matter of fact, regulators really don't want banks to have their reserves in stocks because they're so bloody volatile. So, first of all, so that's just the Federal Reserve or the Office Comptroller. They really want to have stable reserves. So that means things which are very solid and safe, like gold or cash or treasury bills or mortgages and things like that. With things which are pretty stable. Okay. So they're doing it for pure economic reasons. Now, this is the whole thing. And now, this is the funny thing. I love talking about this because I released this information was 2007. So how many years ago is this guy? 17 years ago.
Yeah.
17.
So this is 17 years later, and this still is not part of the mainstream media. So this is what I gave to Bloomberg and CNBC and the whole thing. They all thought I was crazy, but so the reason why they do it is pretty simple. Is first of all, life companies are very stable, particularly mutuals. Now, I'm a snob. I tell people stay away from anything with private equity stock owned. This have something where it's mutual, fraternal, where you have ownership stake in it. All right, first of all. But the reason why banks buy life insurance from their own account, because first of all, it's very, very stable for the most part. They can't leverage their balance sheets like banks can. And as of September, the leverage ratio, guys, of banks versus life companies.
Well, we know you mean the reserve ratio.
Yeah,
Yeah. Yeah. Banks, it fluctuates, right? The highest is probably about 10 at
it's
any
actually
given
higher
time.
than that now,
Is it?
guys.
Oh, it
Yeah,
is currently.
yeah. So actually, after the repo market rose up in 2019, September 2019, so roughly, I don't know, 5 years ago, essentially there's no reserve requirements.
Right.
So they can lend out whatever they want. So banks, they can essentially they're very unstable. But if you really look at it, so people go into a bank, they have look these beautiful buildings and they look really strong, but the fact of the matter, all the money's out. There's really no money in the bank. It's all been lent out. But whereas if a life company go in there and you have $100,000 or $1 million, they have to reserve every penny of it.
Mm-hmm.
They can't do all the shenanigans. So life companies are always going to be more stable than banks. From a mechanical and perspective. They have to their portfolios. They're very constrained as to how they can operate. Now the thing is that's gotten different with the private equity back life annuity insurance, but I'll be getting into that later. But the money as the cash increases on the balance sheet, and they get dividends and stuff like that, that actually goes to their income statement. Not only that is that, because it's a tier one asset, it's considered part of their tier one capital, which is the most important asset of any bank. They can borrow against it or lend it as a leverage ratio. So in other words, if they have, say, something like Wells Fargo, I call them, or JP Morgan, where they have like 10, 15, 20 billion of life insurance on their books, and they do, they can actually multiply that and lend out more money to the public. And then, these guys are not stupid. They, when people die, the life insurance, because the bank is the owner and the premium payer and the beneficiary, the money comes into them income tax free.
Yeah.
Right. So if you've ever had I've been in this business long enough and I've had enough life insurance claims. I realized that in life insurance, even when I graduate eventually, whatever, I know my life insurance will go directly, to my heirs without any problems. But so what we can't say that if we have real estate or other stuff, you can go through probate and be a liquid and whatever. So there's so many really good reasons to do this, and so banks. So I discovered on this, and but it was a hard slog because no one would talk to me. The brokers who sold it wouldn't talk to me. The banks wouldn't talk to me. But I met this kind lady who from the FDIC, who actually showed me how to break down the balance sheets and of the bank. So, and then I discovered that, and so and it's a continuing story. And then so they're still major owners of life insurance, for their own account. And
so that's really interesting. You say, because in the book you talk about how most of these are single pay premiums, which means they're a MEC. They become a modified endowment contract immediately.
They don't care about that.
And if you've ever ran the numbers, I know Paul has before, those MECs look phenomenal. As far as the cash value growth, right?
Oh, yeah.
But of course, when you borrow against that, it's all taxable, but banks don't do that. But what they can do is they can lend, they can create credit out of thin air based on their cash reserves that they're never going to touch, because banks don't lend their own money. They create credit.
That's right. No, so you guys get it. So the whole thing, and then what they do too is that, and some of the stuff took years to figure this out, but then what I figured out is that they don't even care if it's a MEC, because the bankers love it, because they use it as an instrument, and it's in their proxy statements and their 10Ks and stuff like that, is that these life insurance are used to fund employee benefits, which could be executive compensation plans. Yeah. Now the executives love it because they take it could be a modified endowment, and they can convert that in a 1035 exchange. It's actually a portion of the code, if it's converted to an annuity, there's none of this 10% excise tax. So I mean, it's
so the MEC status kind of doesn't matter. So you can convert life insurance to an annuity, and the MEC, because the rule is once a MEC, always a MEC if you would convert it to life insurance. But you go to
But if you convert it to annuity, there's no penalty.
So there's a real interesting article on Jim Harbaugh, the Wolverines Michigan coach, collecting a lot of his pay as whole life, permanent life insurance.
Yeah, I was the guy who kind of found that. It was like we get it was like 70 million or something like that. I mean, it was huge.
It's a lot.
pretty amazing.
Yeah. So, but now where is he? Where he was in Michigan. Now where is he now?
Is he in the NFL? Or is his brothers in the NFL coaching the Ravens, or was? I don't know. I can't keep up with the Harbaughs. I don't know the difference between the two.
Yeah, but the more interesting now, let's see, Paul, you maybe need to see, but one of the things do you have Comcast down there?
I'm not sure if we have Comcast. I have Verizon internet, and there's Cox. There might be my mom. I think my mom has Comcast in Florida.
And how about you, Dave? You're in Minnesota. Where do you have?
I've got the Verizon like plug and play the box. In fact, I have one here in this office because it's so easy. I will never go with a cable company again. Okay, beside the point.
But so all right, so that's besides it. But what did Verizon do in 2012, guys?
I don't know.
They bought an $8 billion annuity to fund.
I was going to say they did some pension risk transfer. I bet. Yeah.
They essentially transferred their risk to an insurance company. I believe it was Prudential. So a lot of these companies, even like Verizon, these banks, and this is one of the things which I discovered, and this will be in the Pirates 3 book, is that a lot of these banks, like Bank of America, Merrill Lynch, bought an annuity for their own pension plan. So an annuity in life insurance, whole life insurance, it's the same church, it's just a different pew, And so they're all doing this. And so what I did is I just went through research meticulously and just kept working on it.
Hey, thanks for listening to our interview with Barry Dyke, episode 1. Stay tuned next week for episode 2. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.